This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 14th. Some highlights from today's show. The S&P remains a tactical buy, US bonds pose a problem, and junk bond CDSs are rising. It's a happy Friday, traders. Welcome to another Daily Market Rundown. Let's get stuck straight into it. Looking across the overnight markets, Asia, good session. Europe, good session. And currently, of course, looking at some of the US indices, they're looking like a rather upbeat session. However, we do have, of course, the roll to contend with. We do have the futures markets now rolling into the June month. So what that typically means for day traders is that price action can be a little bit misleading. You don't want to be chasing what you think might be momentum to the upside, or even chasing what you might think is some sell side activity. So just be very, very cautious. Typically what a lot of day traders do during the roll is they either take off or they just adjust the approach, which is not be too aggressive, like I said, chasing that momentum, not thinking that it's big buy orders coming to the market, when in fact it's more often than not just the roll that's getting through. So just factor that in, of course, as we get into today's session. Now let's get across and talk about our first topic for today, and looking across the news wise, we've recently had this just a couple of minutes ago out. The German Greens have agreed ultimately to back the SPD-CDU plan for fiscal reform. What this means is the investment plan of 500 billion will come into play and will most likely be passed in the Bundestag on Tuesday next week when the vote happens. At the same time, of course, we also have the agreement that defense spending will be allowed to go beyond the current fiscal break rules. Now, this is not necessarily new news. If you've been trading and following this stream for the last couple of days and weeks, we've been talking about how this is most likely going to get through, and there was just a little bit of horse trading going through, and we can see that in the price action, and that's why I've got the euro up here for you. You can see the euro is up only 0.4% of the day. It is outperforming the likes of the pound, the yen, and the Swiss. So there definitely is a little bit of positive sentiment come back in the euro. However, keep in mind this is very much being priced. Okay, euro is up currently 5% on the month, and we're only halfway through the month. So what does that mean for the rest of the session? Well, it's not necessarily bad for euro. It's not bad for DAX. It's not bad for German bonds. Ultimately, it just means that we're going to more than see this sort of straight line moves. We're now going to start to see these trend-like moves develop over time. Okay, we spoke a little bit about this in a stream just a couple of weeks ago. What we're expecting over time is rather than have straight line down moves like that, we'll just get moves that are a little bit like this, where there's a lot more two-way trade, but the general trend in direction will be to the downside in German bonds, and of course the upside for euro and German DAX. Okay, now let's turn our attention to one of the key themes, and it is the Magnificent Seven. This is the week to date performance, and you can see it's blood red across the board. No one has been spared. It's another continuation of this sort of concern in the Mag 7. We've seen some significant outflows this week. Apple down 12%, Alphabet down 6%, our star in shining armor, Meta, down 5.5%. It really is a bloody week for the big names in the indices. We can see Nvidia holding up a little bit better, but keep in mind that's coming off the back of a really aggressive sell-off last week. So the point and why I'm showing you this is that sentiment is still very, very sour. However, it does look like a lot of these names are now starting to stage just a little bit more value trading. What does that mean? Well, it means that we've had the sell-off. Imagine that's the sell-off, and now what they're starting to do is we're starting to see a little bit more two-way trade. In other words, the markets are trying to establish some bit of value. Okay, if we do get a little bit of confidence coming back into any of these names, or at least all of these names over the course of today, Monday, it is going to give participants a little bit more confidence to start buying up some of the indices. So hence the S&P 500 is now a tactical buy. I do suspect come the end of today you're going to see a little bit of green across the board in the Mag 7 names, and that will be a very good clue as to how we're going to start out next week. So pay attention. If the Mag 7 does okay today, we're not talking about magnificent, amazing returns, but if it does okay, if we see a lot of green across the Mag 7 today, don't be surprised to see Monday be another bid up in the Nasdaq, S&P, and Russell. Now let's go and look at that Nvidia chart. As you can see, we had that sell-off earlier this week. You can see Monday was very much a contained day. But you can see over the course of the last 7 sessions, what are we doing? We're just effectively now accepting value between 100 and somewhere around this 120. Okay, that's all the market's doing now. It's had that aggressive sell-off, and now it's trying to establish some form of value, some sort of a, where buyers are entering and of course where sellers are entering. Now where we get up to today is anyone's guess, but like I said, I think 120 is going to be the first test for Nvidia, and then I do expect that we are going to see some sellers re-enter there. We get above it, it does open the door of course to a retest of 124, and then that very important resistance we've been talking about for some time around that 127, which coincides with the 200-day moving average. Okay, so pay attention to the Mag 7. I think that is going to be a key theme for today. And then turning across to junk bonds, I think they're getting a little bit of attention in sort of Twitter land. Lisa Abramovich has come out with this tweet yesterday talking about sort of credit markets and why are credit markets so stable. Okay, what you should see ultimately in a sell-off or in a corrective type move is follow through over into some of the bond markets, particularly the more risky bond markets. Okay, and so she's posted this chart and she said, well, look, finally we are starting to see a little bit of rise in the yields that are being demanded to hold more risky type bonds, and that's the chart she's posting. However, she is adding a caveat there, which is, look, it is still very, very low by historical standards. Now, this is going to be important to watch because if this is a correction, if this is the US economy going into a recession or a soft landing, the reality is you should be seeing much, much higher yields. Okay, the fact that credit spreads are still so tight despite what we're seeing in equities does kind of tell us that perhaps the move in the equities has got nothing to do with the economy, and the economy is absolutely fine. Okay, the bond markets are very seldom wrong, and right now the fact that investors are not demanding substantially higher yields suggests that maybe things aren't actually as bad in the economy. In actual fact, this is just a very, very healthy correction. So hence, keep a very close eye on this because, again, sentiment is one of those things that, look, everyone is talking recession nowadays, but it can flip so quickly, okay? And right now, credit spreads are suggesting that that flip could happen, okay? Now, this is a chart where we've zoomed out a little bit in terms of the junk bond prices. Okay, so I just want to use 2022 as an example because this is what you should see ultimately when there is an economic growth scale, where there's concern about growth. Okay, if you go back to 2022, we had a very, very healthy correction in the stock markets, and you can see junk bonds absolutely sold off. Okay, a significant sell-off. Fast forward to today, what have they done? Absolutely nothing. Okay, the junk bonds are really not reflecting any kind of fear. If we then go and have a look at some of the CDSs on these junk bonds, well, yeah, they've woken up a little bit this week. Okay, we can see there is quite a bit of movement this week. However, where are we? Well, we're still well contained within where we were last year. And more importantly, if you go back to last year where we had a little bit of a growth scare, what did the CDSs do? They rallied and sold off. Okay, we're not even at those highs made back in July, August last year, and this is at a time when obviously markets are trying to compare it to July and August last year. So again, the reason I'm showing you these charts is fine, it's all good and well talking about a growth slowdown, and we spoke about this earlier this week. This is not a recession. This is not even the market pricing in a recession. It's simply just a little bit of concern that maybe we're not going to have as good a growth year as originally expected, and that's what's creating the correction. Now, sure, can this change? Well, look, if these CDSs next week suddenly pop above those highs of 24, fine, all bets are off. Then maybe we are going to head into some form of an aggressive slowdown, a hard landing, and even maybe a recession. Okay, of course, all of it's possible, but right now, markets are not suggesting anything other than we still have a really good US economy. Okay, so be careful with this whole sort of the world is ending type narrative. Equity markets have now corrected. They've done a significant move, and of course, all the analysts on the street are still thinking double-digit growth for the S&P 500 this year. So don't forget that. Now, let's turn our attention to that S&P because it's a fascinating chart. We've now double bottomed and held that 55.25. You can see it's a September low from last year. It's held on to it. Keep in mind we have obviously had a 10%, slightly more, 10% correction as of yesterday. We did hold the close there, but again, as you can see, this one-time framing continues. Okay, one-time framing, we simply just cannot close above a previous day's high. When we do close above a previous day high, that will signal out a short-term bottoming process. And again, this is why we're talking about a tactical buy opportunity. One of the traders on the floor actually showed me this chart yesterday. And I think the fascinating discussion we had was that, is there a good risk reward in being short now? The short answer is absolutely not. Fine, if we suddenly get some key economic data really weakening aggressively, sure, perhaps this can continue, but risk reward to be short right now is not good. Okay, like I showed you, some of those bond markets are not pointing towards anything other than a little bit of a recalculation of growth expectations this year, not anything close to some form of a recession. Okay, so what that does point to is a lot like the Nvidia. What I expect to see is something similar to 22. This is the 22 correction. You can see we had the initial 11.25% sell-off. The market then established value for 5 sessions, a lot of overlap. It then extended a little bit and formed another little distribution. So 2 distributions, filled out the middle of that distribution, and then extended. Okay, I expect almost an identical play now. I expect today we're going to have a relatively strong session, perhaps even a close above yesterday's highs. We get that. It does mean early doors next week we are going to come up and test that gap around that 57.60, perhaps even push a little bit higher onto that trend line. Who knows? But ultimately, I do think we're going to get a pretty wide distribution range over the course of the rest of this month. So keep a close eye on that, because I think the S&P 500 is a fantastic tactical opportunity. Now, with that in mind, Jim Bianco came out yesterday. A fascinating sort of idea he had was he was pointing towards how even with this 10% correction in the S&P 500 in the green, what have 10-year bond yields done? Okay, if we sort of think about when that 10% correction started, right now 10-year yields are only 8 basis points lower. Now that should leave you scratching your head, because what we typically would get when we have this sort of an aggressive sell-off in ultimately bonds is a much lower level of yield. Okay, obviously we know that the Trump administration has been sort of trumpeting about how proud they are that yields are moving lower and that their tariff talk is doing the work. Well, in reality, guys, bond yields are not really corresponding in the same way you would think. Okay, now, this matters for a number of reasons, because if we were to suddenly see these yields accelerate back up to the upside, whether that's because tariffs are inflationary or because we're seeing a lot of issuance from countries around the world, the reality is that the US is going to be paying a lot more for their debt later on this year. Okay, and that will be a massive concern for the markets. Why? Well, because we know they've got a ton of issuance to do in the second half of this year. So again, keep a close eye on yields. Probably not a problem right now, today, tomorrow, this month, but will become a problem at some point later this week. More importantly, as a trader, as a day trader, you don't want to be buying bonds when equities are selling off. And in actual fact, if these equities do start to stage a little bit of a bid over the course of the next couple of sessions, watch out. There are a lot of long bond positions. Don't be surprised to see those bond yields tick back higher next week. Now, with that in mind, we have a data point out today. It's the University of Michigan. And the sort of the prompt I've got here is sentiment set to sour. Well, I think we could be in for quite a surprise miss today, and I'll tell you why. You go back to 2022, which is this vertical line I've got here for you. And effectively, that was when the market correction began. It began right in December 2021. And what we saw early doors in 22, was a very aggressive sell-off in the sentiment in the University of Michigan data. Why? Well, guess what? When your 401k is getting slammed like it has been over the course of the last 2-3 weeks, you're not exactly going to tell the survey people that you're having a great time and a jolly time. So the wealth effect will play a role when it comes to this University of Michigan index. So keep a close eye. I do suspect we're going to get some ugly prints, perhaps maybe not today, perhaps today, but over the next couple of University of Michigans, I do think we're going to get some misses. What does that mean for general market sentiment? Well, I don't think it means too much. I think what will get sort of market participants interested today is what is the inflation expectations. But again, there's far more important things today. And like I said, at the moment, the market wants to get beyond the roll and of course wants to get into next week, where we should get some more information and updates on the tariff situation. Okay, with that in mind, of course, it is a Friday. It is a roll week. It has been another big week for the markets. If you were trading yesterday's session, you would have noticed a little bit more tighter ranges, volumes very low. So again, as a day trader, it's so important to know when those volumes are there and when to back off. Yesterday, the signals were sent, back off. Guess what today is going to be? It's going to be more back off type signaling. The volumes are just not there right now. I think people are exhausted from the back and forward. Also note a lot of the Trump tariff commentary, you'll notice the market is actually not as sensitive to it anymore. And again, this is just following along that same theme, which is people are generally exhausted. And what that means is you're going to get a lot more two-way trade. Okay, so be careful chasing momentum. That is the key message for you today. Don't go chasing that momentum, particularly not on a Friday, particularly not when we have the roll going through. With that in mind, of course, manage that risk. Go make some money.